Welcome back to the Tesla Daily News Podcast. Today is Sunday, February 8th, 2026. In the next few minutes, we're digging into several Tesla stories that could actually move the stock, big shifts in full self-driving strategy, a key China autonomy milestone, fresh legal and reputational risks in core markets, and a few competitive signals investors should not ignore. Story 1. Tesla is making a major pricing and packaging shift for full self-driving, and it could reshape software revenue. The hook here is simple. Tesla is reportedly ending the one-time full self-driving purchase and pushing buyers toward a monthly subscription. The context is Tesla's long-term margin story. Auto gross margins have been under pressure in recent years across the EV industry, so higher margin software revenue is critical to the valuation narrative. The details we have from recent reporting: the current one-time full self-driving fee is $8,000, and the change is tied to February 14th, with discussion of a $99 per month subscription approach going forward. The reporting also suggests Tesla may change what is included in basic autopilot features, which could influence customer satisfaction and take rates. Impact for investors: moving from a one-time purchase to subscription can be bullish if it increases lifetime value per car, improves cash flow consistency, and boosts attach rates because the upfront price barrier disappears. But there's also risk. If customers perceive the baseline feature set as being reduced, it can create backlash, higher churn, and brand damage. Markets tend to reward recurring revenue, but only if retention is strong. Takeaway: watch for confirmation from Tesla, watch customer sentiment after the change, and most importantly, watch whether Tesla reports higher software take rate or rising subscription adoption in the next earnings cycle. Story 2. Tesla has launched an AI training capability in China, and that is a critical step for FSD in the world's biggest EV market. The hook: Tesla is reportedly building local AI training capability inside China, which directly addresses the data and compute bottleneck that has limited advanced autonomy features there. The context: China is not just a big market, it is the market where local EV competitors move fast, price aggressively, and where regulations and data localization rules can block foreign companies from training models the way they do in the United States. The details: reporting says Tesla now has an AI training center in China. Even if you don't care about the technical side, the business meaning is clear. Tesla can iterate its driver assist stack faster with China-specific data, without relying on cross-border transfers that can be restricted. Impact: if Tesla can accelerate autonomy performance and feature rollout in China, it helps defend market share and supports pricing power, especially as Chinese automakers push strong hardware at lower prices. It also supports the broader robotaxi optionality thesis that underpins many bullish Tesla models. The risk is that regulatory scrutiny increases as autonomy features expand, and any safety incident becomes more politically sensitive. Takeaway: for Tesla, China autonomy progress is not a side quest. It's directly tied to growth, competitive positioning, and the software margin narrative. Story 3. Tesla is exploring expanding solar cell output in the United States, aligned with a much bigger solar ambition. The hook: Tesla is reportedly evaluating multiple sites, including New York, Arizona, and Idaho, to increase solar cell manufacturing. The context: Tesla's energy business is often the quiet grower behind the car headlines. Energy storage has been the brighter spot recently, and solar has been more uneven. Increasing cell output suggests Tesla is trying to build a more reliable supply chain for solar products and scale. The details reported: production at Tesla's Buffalo, New York factory is set to expand, and Tesla is considering additional U.S. locations for solar cell manufacturing. The ambition cited is a 100-gigawatt solar goal tied to Elon Musk's stated vision. Impact: if Tesla can scale solar in a disciplined way, it broadens the narrative beyond autos and can increase total addressable market. But investors will care about execution and margins because solar has historically been a tougher business than storage. Capital expenditures and ramp risk matter here. Takeaway: watch for signs Tesla is pairing solar scale with Megapack and Powerwall growth because bundled energy offerings can improve unit economics and customer stickiness. Story 4. Tesla is facing another lawsuit tied to door handles and post-crash egress, adding legal and regulatory risk. The hook: a new wrongful death lawsuit alleges a driver could not escape a burning Tesla due to door handle and door opening issues. The context: safety-related litigation can create two kinds of stock pressure. One is direct cost, meaning legal settlements and potential recalls. The other is narrative risk. Headlines can influence regulators and consumer trust. The details in recent coverage: the lawsuit centers on a 20-year-old driver, and it includes reporting of a distressing emergency call while trapped. Additional coverage notes Tesla has faced multiple similar claims over time relating to electronic handles and emergency exit behavior. Impact: Even if a single case is not financially material by itself, repeated cases can increase the chance of regulatory action, design change requirements, or higher warranty and recall reserves. It can also affect insurance costs and resale value perception, which matters for demand. Takeaway: investors should track whether this stays as litigation only or escalates into broader investigations or required design changes across the fleet. Story 5. Tesla's brand reputation in Germany has reportedly fallen to last place in a major study, and that has real demand implications. The hook: Tesla is reportedly ranked dead last in a reputation survey in Germany, Europe's largest car market. The context: Germany is not just another country for Tesla. It's a key battleground where Tesla sells Model Y volume, where Berlin is strategically important, and where competition from Volkswagen, BMW, Mercedes, and fast-improving Chinese brands is intense. The details: the reporting cites a reputation score of 2.48 for Tesla and describes a sharp year-over-year collapse, placing Tesla behind companies with already weak reputations. Impact: brand damage can show up as lower order rates, higher price sensitivity, and weaker loyalty, which ultimately hits revenue and margins. In Europe, where incentives vary and competition is broadening, reputation can be a meaningful swing factor. Takeaway: watch European registration trends, pricing actions, and whether Tesla can stabilize sentiment with product updates, service improvements, or clearer messaging. Story 6. Tesla's Optimus humanoid robot appears to be progressing slower than the most ambitious early claims, and that matters for long-term valuation narratives. The hook: recent reporting says Optimus robots in Tesla factories are still at a learning stage rather than doing broad autonomous work. The context: the robot story is part of the multiple expansion thesis for Tesla. Bulls often treat robotics as a potential second major platform after vehicles and energy. The details highlighted: Elon Musk previously discussed very large ambitions, including selling up to 1 million robots per year by 2030. The reporting suggests reality today is more limited, with only a small number of units and a focus on training and learning. Impact: near term, this is unlikely to move revenue, but it can influence analyst sentiment and the credibility premium that Tesla sometimes receives. If robotics timelines slip materially, some investors may discount that optionality more aggressively. Takeaway: treat Optimus as long-duration optionality. The stock tends to react when Tesla provides concrete proof points, like real factory productivity gains, rather than aspirational unit targets. Now, a quick competitive and sentiment check before we wrap. One notable comparison floating in the EV ecosystem: independent vehicle tests in markets like Scandinavia continue to put pressure on Tesla's value proposition, especially when competitors launch strong family crossovers priced aggressively. And on pricing, we're seeing competitors offer big discounts, like a reported $10,000 incentive on certain Hyundai Ioniq 5 trims. That matters because sustained competitor discounting tends to pressure Tesla's pricing power and can force more incentives or feature differentiation. Let's close it out. Today's big themes were: Tesla is shifting full self-driving towards subscription economics, Tesla is making a key autonomy infrastructure move in China, and Tesla faces growing non-technical risks through lawsuits and brand reputation in Europe. For the stock, the upside comes from software and autonomy scaling. The downside risk comes from execution, regulatory scrutiny, and demand sensitivity. For tomorrow, watch for any official clarification on the full self-driving pricing changes ahead of February 14th, and keep an eye on China and Europe demand signals, because those regions can quickly change the delivery and margin outlook. If you want this kind of Tesla investor-focused roundup every day, subscribe to the Tesla Daily News podcast and follow us wherever you get your podcasts for the next update.